Okay. All right. Hi, everybody. Welcome. My name is Heather O'Neill. I'm the 2021 chair for the committee this year for YPN, and excited to see all of you. First up, I want to introduce Russell Wimbrow. He is our sponsor for today from Cutco. So Russell, if you just want to take a couple of minutes and explain who you are and what you do, that would be great.
Sure, let's roll.
Do this.
Let's do it. Let's do it up. Hey guys, Russell with Cutco Closing Gifts. Real quick, gonna give away 2 free pieces of Cutco. This goes for everybody that's on this. Text your name to my cell phone number. This is just to win a free piece of Cutco. And then I'll do a drawing and put the winner in the chat box. And then I'm gonna move on. My phone number is still on there. But whoever gets the closest or can answer this question gets the second piece of Cutco. According to Inman, how many touches per year do you have to have with your clients so that they can remember your name? That's for the second free piece. Give you guys a sec, and then I'll move forward because I want to stay punctual. Everybody got it? Yeah? All right. I'll put it in the chat box too if some of y'all going kind of slow. Now, any good realtor or lender knows at the end of a transaction is actually the beginning of a lifetime relationship with your client. Everybody has the chance to brand themselves, which usually goes by the wayside. Talking about closing gifts, not here today to tell you what you give your clients is bad or anything like that, because everybody loves free stuff. Does anybody on here know what happens to most closing gifts? Anybody at all?
They get thrown out.
Yep.
Thrown out, right?
They get drank because it's a bottle of wine.
Right? Except a different way.
95% of closing gifts are consumed, used and gone. You've got baskets, gift cards, wine, dinner out, sweets, things like that. The other 5%, they go on a wall corner, end up getting forgotten about, and collect what?
Dust.
Dust. You've got your door knockers, doormats, pictures, plants, paintings. You've got the more personal gifts. Now at our company, what we believe in is it's not your client's job to remember you. It's your responsibility and obligation to make sure they never have the opportunity to forget about you. And how we do that is we brand you forever. And when I say forever, who is here today that owns Cutco, has given Cutco as a gift, has received Cutco as a gift? Raise your hand. Sweet. See these people raising their hands. These are the sexy and intelligent people that are taking this tax class today. But we can always get some more hands up. Now, does anybody out there own it for more than 10, 15 years that's taken this?
Me.
Sweet. Well, we'll stop there because we don't want to start going in the age, even though this is the young people's network thing. But imagine giving your client a gift they're still using 10 to 15 years later, almost every single day. It's a pretty practical closing gift. For you guys that haven't heard of our products, they're like the Lamborghini or the Rolls Royce of the kitchen with a Snap-on Tools guarantee. They're guaranteed forever. They last forever. They're 100% American made. The knives are on the History Channel. They're the world's sharpest knives. The handles have been on Modern Marvels, and the shears have been on the Discovery Channel. We also make the K-bar knives for the United States Marine Corps. These are our shears. If you can see me right here in this picture or the video, whatever you want to call it. This is a penny. I'm going to show you all the quality of these really fast, how they work. These are really cool. If you can see what I did to that. Now, if you guys want to give these shears to your clients, these shears come apart. And the reason why the shears come apart is every once in a while, you might have a client you don't like that much. So what you do is when you go to closing, you give them half at closing. And then when they actually give you a referral, you give them the other half, right? That's a joke. You can't do that. That's unethical. They come apart so you can clean them. Now, since they're guaranteed forever and they last forever, we take them, we brand them with your name, phone number, some kind of logo, some kind of snazzy tagline. And then we put them in the most used room in the house, which is the kitchen, right? It's the center point of the home. It's where everybody comes together. We actually came out with the red handles for realtors. The white and red handles pop and draw attention when you aren't around. They are a natural conversation piece. Let me roll forward through these real quick to save some time. Does anybody know how much you all can write off per gift per client by the IRS?
$25.
You're limited to $25 per client per gift. Now, since these are engraved, they're considered promotional products or advertising, so they're 100% tax deductible. This is money you're already spending anyways. You might as well get the full tax write-off. And I'll go ahead and wrap up. The gifts range anywhere from $50 to $250. We've also done a lot of extensive research. We found these gifts will work for most of your clients because most of your clients do eat food every day. And then how we work, we get a system in place. We ship the gifts to you up front. That way you have them. You don't have to drive all around town trying to find the perfect gift for every client. And then how we work. Let's say you do 10 deals a year. You can order at the 10 level. We buy you an extra gift at no charge. We ship them all to you up front. We bill you out over 6 months or 12 months with no interest. So it's really easy on your cash flow. If you do 25 deals a year, you can order at the 25 level. We still buy you additional gifts. We still ship them to you up front. We still bill you out the same way. And then what I do for people who do like to take action, for anybody that's on here today, not only can I lock you into a bulk discounted rate, but for the first 3 people who would like to place an order, I'll personally buy you $150 worth of the product for your house as well. That comes directly from me to you. You want to be one of these people, you can text SHARP to my cell phone number and I will follow up with you later. And I will put the winners of the cut coat in the chat box along with my information. Hope you guys have an awesome day.
Thanks so much, Russell. Appreciate it.
Yep.
So first of all, I wanted to start introducing our 3 panelists. First up, we've got Karen Redding from Liberty Tax of Fredericksburg. Hey, Karen. Karen's originally from upstate New York. She arrived to the area 25 years ago with her Marine husband and has called it home ever since. 3 mostly grown sons and 2 tax offices keep life busy and very interesting. Her tax offices are franchise locations of Liberty Tax Service and were originally established in 2004. And Karen is an enrolled agent and a top 10 ranked office nationally. And I have to give you a shout out. Karen's actually my accountant and she deals with my husband and I, and we are disasters. So hi, Karen. Next up, we've got Doug Gargan of Gargan's Tax Services. Doug was born in Brooklyn, New York and raised on Long Island. He's married with 3 adult children and 9 wonderful grandchildren. For 38 years, Doug has worked as an accountant for small to Fortune 500 size companies. And for the past 29 years, Doug has prepared income tax returns for individuals, small businesses, and corporations, and is a member of multiple professional associations to help stay on the cutting edge of changes in the accounting and tax world. On November 2nd, Doug celebrated his 9th anniversary of owning his own business. Hey, Doug.
Hey, thank you.
You're welcome. And finally, we've got Bob Brammer of Brammer and Associates. Bob has been running his own tax business here in Fredericksburg since 1995. He works with his wife and 2 other tax professionals in an office near the train station downtown. Both he and his wife are enrolled agents, which means they're licensed by the Treasury Department to represent taxpayers before the IRS. Additionally, Bob is a member of the U.S. Tax Court Bar and can take a case to that court if necessary. In addition to taxpayer representations, they do accounting and payroll prep and do all tax returns. In 2018, they were a finalist in the Best of the Burg. In 2019, they were runner-up, and in 2020, they won Best of the Burg in the accounting and tax category. Hey, Bob. Welcome, everybody.
Hi, guys.
Hey, so let's go ahead and start this off. Our first question looks like it's geared to you, Bob. Do you need an EIN number?
You don't have to have one. However, if you don't have one, you end up putting your Social Security number on a lot of things you really don't want it to go out on. So getting an EIN is a really good piece of advice. And also, if you've got something like an LLC, you have to have a separate EIN for that. But if you're operating on your own and just Susie Seller, you don't have to have one. But it's not a good idea.
Okay, great, thank you. Our next question looks like this is for Bob again. should I or do I have to file as an LLC? And how does setting up an LLC change things?
Okay, a limited liability company is an entity separate from you. It's not, for tax purposes, it's called a disregarded entity. It means you're still self-employed even if you have an LLC. If you have an LLC, you can elect to be treated differently for tax purposes. You can elect to be treated as a corporation or as an S Corp, but you don't have to. But anybody that doesn't make a choice with a single owner limited liability company is self-employed. Doesn't change a stinking thing. You still use the Schedule C on your tax return and you go along just like normal. Now, I'm not an attorney, but I'm going to lean over into the legal side of it a little bit. A limited liability company provides you with liability protection for errors of omission or commission, if you will. Right now, if you're self-employed and you're out there doing your thing, if you really screw up and you exceed the limits of your insurance, everything you've got's at risk. So an LLC tends to protect you against that. It limits your liability to what you have invested in the company. That's a real short answer, but that's kind of where it is.
Okay, great. Thanks. Does anyone have anything to add? Anyone add to that?
I just wanted to say, I totally agree with what Bob said. I think an LLC is a certain presentation to the business community that you've taken the time and the effort to create one. So it presents that you're in this business to make it last. So I like the fact that you do the LLC. And for the tax reason, which is a huge one, if you hire an independent contractor and pay them $600 or more, to Bob's point, well made, a tax ID number has to go on that form. Well, I'd much rather have it be a federal ID number than my social security number.
Okay, thank you.
All right, let me go just one step further. Doing an LLC is not terribly difficult. It's basically a one-page application with the State Corporation Commission. Here's my name. Here's the name of the business I want. Here's the date I want to start, and sign it. That and a few bucks, and you're good to go. And you got to renew it once a year. If you don't renew it, you lose it. But it's not hard to set up. A single member doesn't require a lot of documentation. If you go into a partnership or something like that in an LLC, you really need some partnership operating agreements, and you need to talk to an attorney about that one. But just to do it for yourself, it's not hard. It's really a piece of cake.
Okay, great, thanks. So the next question we've got, it says, if I set up an LLC, is it still covered under the E&O insurance I get through my broker? Or does that just cover me as an independent contractor? We did receive an answer from a FAAR broker, and they said, yes, because it covers them as a licensee, and they are first and foremost a license, they have a second license for LLC, which does not require another E&O policy. Does that sound correct to you guys?
I wouldn't touch that question with a 10-foot pole. That's seriously a legal and financial question that I'm not prepared to answer because I don't know the answer to that. I'm glad you asked a realtor, a broker.
Yeah. Okay, great.
I'm not an expert, but I personally think it would depend on each individual's broker's actual policy as to what it covers or does not cover. So I don't know that you can necessarily give a blanket answer. I think if someone wanted to create an LLC, they would need to meet with their individual broker to find out whether or not it would be covered based upon the type of policy they have.
Great. Anybody else have anything? Good. Okay. All right. Our next question looks like it's for the three of you. What's your number one tip with regards to record keeping as an independent contractor? We'll start it off with Karen.
Yeah, very first thing that I work with a lot of realtors is you have to treat yourself like a business. It's you can't, be running everything through your personal checking account and think that you're going to get to the end of the year and try to do that. So again, just like the LLC is so easy to set up, when you get that letter from the IRS with your employer identification number, take it to the local bank. It's free. Business checking should be set up immediately. Everything, all of your transactions on the business side should run through that account, and it's starts the record and bookkeeping process for you. Everything goes in, everything comes out. I don't care if you swipe money out of it every week, because obviously you work to make money, that's fine. But that's hands down the easiest step for most people, is to try to start creating a process.
Thanks. Doug or Bob?
I think that's a great idea. In fact, I would even extend it to if you were going to get a credit card, or the bank would set it up in your business name.
Yep.
You don't want to start using your personal credit card with your business, because you're commingling your activity and your fund, and you want to keep your business activity separate from your personal.
I've got to agree that one of the biggest problems we have with people that for whom we don't do, well, even some of those we actually do the bookkeeping for, is mixing personal and business. It's just a pain for us to keep all this stuff straight and figure out, well, was that trip to Wawa for business gas, or was that a personal thing? You know, if it comes in the middle of a shopping trip to Wegmans and Costco, it's probably going to be a personal vehicle. But trying to figure that out is tough. Keeping receipts. Get yourself a 12 division folder. Put January in one, and February in one, and March in one, and keep your cotton picking receipts. Not having receipts is one of the biggest bugaboos we have about what did you do with it. I have a I'm sorry, excuse me. I have a client as a paver up in Maryland, and they were terrible about taking the receipts to the wife of the guy that owned the company. So she had 5 kids, and she said, everybody goes out and gets a truck. The first one that comes back with the receipts gets to pick the flavor of the ice cream. Well, everybody went out and hustled because they didn't want the oldest one to pick the flavor of the ice cream because she liked vanilla and nobody else did. But you know, whatever works for you to keep the receipts and the records. And if you don't have the receipts and records, you've got a problem. And if you come to our office without them, you're probably not going to get the deduction.
Thanks. We do have one. It looks like piggybacking on that. If you have it documented on a credit card statement, do you still need the actual receipt?
It's good practice to keep your receipts, only because sometimes it can be kind of questionable. If you run into Giant and spend $79 in there, is that your personal groceries, or is that easily provable that you picked up a bouquet of balloons and everything that you needed for your open house or something like that? So I do recommend people, I like Bob's idea. The simpler you make it, the more likely you are to be successful at it. So it's just using that monthly system. I always say it doesn't even have to be organized at that point. If it's all in January, I can generally figure that out.
Okay. And we do have one more question real quick. It said, if you track your expenses in QuickBooks, do you need the receipts?
Absolutely.
Yep.
Excuse me. Let me tell you, like I said in my intro, I do some tax court level work, and I do representation level at appeals with the IRS. You can get an auditor that says, okay, I see where you went to wherever and charged whatever. Let me see the documentation behind that. Okay, I see the documentation. That's fair. Now show me the check where you paid the bill. Show me that check came out of an account in your name. I mean, if an auditor wants to be hard on you, they can really do it. Document, 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 and keep it beyond doubt. It sounds ridiculous, but I have seen an auditor go to that level. Obviously, the taxpayer ticked them off, but yeah, it can happen. The better you got it documented, the safer you are.
Exactly.
Mm-hmm. All right. Thanks, you guys. Next question looks like we're going to start off with Karen. What do you recommend for keeping records organized?
I honestly, I think we've covered it. It won't beat a dead horse. It's number one, business account. Absolutely. Everything goes in, everything goes out. Usually I say partner that checking account with like a money market account off to the side. It's my realtors that can keep up with their estimated payments and stuff throughout the year. We have a formula that we use based on their business, and they know at every closing, whatever their formula is, they put 75% into their checking account and swipe 25% over to their money market account. So they always are prepared to pay estimated taxes. Obviously, that's a given. So I say a separate bank account for the business, separate credit card, because we just live in a world nobody pays cash or writes checks anymore. And then the third thing, it's probably the biggest headache for realtors is going to be your mileage. So something super simple like Mile IQ. I'm not very tech savvy. I figured out how to use Mile IQ without too much problem. So if I can do it, anybody can do it. So those are probably the three biggest things that will cover 80% of your headaches for you.
Okay, great. Let's see. We also had a question here. Speaking of mileage and tax deductions, is it important to capture the number of miles only or the actual odometer reading on the vehicle?
I'll tell you, it's important to capture both. We have seen audits on mileage. I always say, I don't think you have to write the odometer down every single day. If you, again, worst case scenario, start at the beginning of the year or thereabouts in the end of the year. And that lends back to if you should get audited, there's ways to be able to support the mileage that you're taking, like with receipts from oil changes and things like that. So what might seem excessive to one person, if it's provable, so I always say form your argument ahead of time. If you're going to claim 30,000 miles, be able to show support. And I always say, look for something that's an unverified third party. So Jiffy Lube is not in cahoots with you. They're just going to jot down or record your mileage every time you go in there, so they can support. If you had a Jiffy Lube receipt in January that shows 14,000 miles and you had a Jiffy Lube receipt in December that says you have 24,000 miles, but you're claiming 15,000 miles of business miles, there's a problem there because there wasn't 15,000 miles put on the car, and that would create a problem for you.
Okay, thanks. Speaking of cars, we're kind of moving on here to Doug. Can we write off the maintenance for our vehicles, and what about our car payment?
Excellent question. It depends upon which method that you employ in tracking that expense. There are two. One is a standard. That is a fixed mileage amount. Like, for example, in 2020, if you drove 10,000 business miles, you could write off 57.5 cents per mile, or $5,750. That would be the standard method. You would still need to maintain the mileage log, though. You just couldn't pick a number out of the air. And I like Karen's point, because the IRS at a minimum wants the beginning and the ending year odometer readings. And then do you have to keep it daily? I don't think so. There's other reports that you can run where you go maybe to a specific location and you can keep track of it that way. Now, the other method is a much more difficult one, and that's called actual. That's where you keep track of your fuel, your actual fuel, your repairs, your car insurance, your property tax. All that adds up together. And again, your mileage log dictates what percentage of that you can write off. For example, let's just keep it simple. Say you had total miles on the vehicle of 10,000. Well, when you went back through and you looked at your mileage log, it told you, well, wait a minute, 9,000 was actually business and 1,000 was personal. Well, that's 90%. 9,000 divided by 10,000 equals 90%. So then you can write off all those things I was talking about. And I did omit depreciation, not on purpose, but that's one that also can be calculated as well. Now, you asked about car payment. In the standard mileage, you can't write off a car payment. Now, you can write off the interest expense based upon the business percentage with a standard mileage calculation. On the other flip side, on the actual, you can write off the interest as well, but you cannot write off the principal amount of the loan. So if you're paying, I don't know, $9,000 a year, $750 a month in a car payment, and of that 9,000, only 15% or $1,350 is interest, that's all that you can write off. You can't write off the whole 9,000 that you paid in purchasing that vehicle. So that's kind of a long answer, but that kind of takes you through the different methods. And I call myself a tax advisor because I think it's so important to look at a situation. I had a realtor a number of years ago based out of Richmond, and we sat down, new client, and he said, I'm buying a new car. I'm going to spend about 20 grand on it. I said, okay, there's nice write-offs there. He said, but I have clients in Northern Virginia. And I said, okay, let me get this straight. You live in Richmond, but you have clients in Northern Virginia. Oh, yes, 2 or 3 times a week. I travel to Northern Virginia because I have such a large following. I said, okay. So we literally ran the numbers for 5 years. And in the first year, the actual method generated a much higher deduction because there's bonus depreciation and there's things you can write off. Well, in years 2 through 5, the standard method absolutely killed the actual. And when we looked at it in totality, believe it or not, it was better for him to not use the actual method, but instead to use the standard. He loved that because he didn't have as much record keeping to do. But that's what a tax advisor does. He looks at a situation and does what's best for his client. And that's what I always attempt to do.
Okay. We have a couple more questions tied to this. We have one that came in. If you're an LLC, can the LLC purchase the car, and then what can be written off? Anyone?
Okay, yes, the LLC can purchase the car, but the same rules still apply. You got to have mileage. You got to have the records. It's not a freebie to have the business buy the car and everything's great and glorious. Doesn't work that way. You still got to have the mileage. You still got to have the records to substantiate the business use of the car. Exactly. Personal use isn't deductible. And let me go back to what Doug was saying a second ago. If you're using the actual method where you keep the records for tires, batteries, gas, and all that, that's fine. You can do that year after year. But if you switch from the actual method to the mileage method, you can't go back with that vehicle. Once you go to mileage, you got to stay there. So that's something else to figure into your thinking too.
And one other question with vehicles, what's the benefit of leasing a vehicle versus owning? You get better write-offs or?
Okay. There are 2 types of leases. There's a lease that's where you're renting the car, and there's what's called a capital lease where you're effectively buying the car. If you have a capital lease, which is one where you buy the car for $10 at the end of it, you might as well think of it as you're buying the car with a loan from the bank. If you're using the operating lease, the one where you're effectively renting the car, same rules apply. How much of it's business mileage, how much of it's personal mileage, that determines how much of that rental purchase you can write off.
Okay. Anyone else have anything to add, Doug or Karen?
No.
Good. Okay. All right. Let's see. Next question, another car question. Does our vehicle need to be registered for business only? And this goes to Doug.
The counties have a way of finding that out because there's something called a credit for your personal property taxes. So when you declare on your tax return the percentage of business use, if it goes over 50%, which is the criteria to use depreciation, you're going to lose that personal property tax credit is what you're going to do. I've been in business for a lot of years, and I have most of my clients, business and personal, their vehicle is used both. But believe it or not, I did have a realtor a long time ago. I couldn't put a date on it. And he said to me, when I met with him and interviewed him, he said, well, I'm going to be able to write off 100% of my vehicle. And I said, I don't think so. I said, how can you prove that? He said, I have 2 cars. And I said, okay. He said, one car is registered in the business and the other car is personal. So he literally bought an extra vehicle to use exclusively for his business. So in that scenario, yeah, that was 100% because that's all he used that car for. The other car was also for personal. So, but that's very, very rare. I don't think people are going to go to that length to try to get an additional write-off. But I don't know of anything specifically that you have to say. Probably to your insurance agent, you want to make sure that he knows it's a business vehicle, so that, you know, you get a break there, or if you have to pay more, at least you know that you've disclosed it up front.
Okay, great. And then someone just asked, is there a particular weight of car you can get a better deduction with?
Well, there's two types. There's actually a luxury automobile that's under 6,000 pounds, and then there's one that's over. So the vehicle that weighs more, you're going to get a larger deduction.
Okay. All right. Thank you. Next question. This is for Doug. Cell phone deduction. How much can we deduct? What do we do?
Cell phone, business use. I think that's been what Karen and Bob and I have all been saying. Now, how do you track that? That's because oftentimes my clients will come in and say, well, I use my cell phone 80% of the time. And I said, can you prove it? And they'll say, well, I don't know. And I'll say, here's a simple thing to do. You're not going to like initially what I say, but take 3 months worth of bills, go through them, look at what you have for business, look at what you have for personal, come up with a percentage. If you see that in each one of those months, the percentage is close to 80%, it's 78% one month, it's 82% the next, then you can probably go with 80. But I would again look at it at the end of the year. You might look at it earlier in the year and then look at it at the end of the year to substantiate what that business percentage is. Because you don't want to just arbitrarily say a percentage and then have nothing to back it up, because things change. You may be crazy busy in the spring and in the summer, and then maybe not so much in the fall. So your business percentage may drop down. So you want to pay attention to the business activity, and that will tell you how much you can write off on your cell phone.
Okay, great, thanks. Next question is for Bob. How much can I write off for client gifts? I know we touched on that a bit before.
The answer is $25 per client, and that's a husband and wife, not $25 each. It also includes people in the family, unless you have a separate business relationship with somebody in the family. So it's 25 bucks, guys. It doesn't matter if you give them 100 bucks or whatever. It's 25. If you've got something that's a de minimis gift, if you've got a pen that you've got your name on, well, that doesn't count toward 25. Those are freebies in the calculation. But if you're giving, bottles of wine, or if you're giving gift cards to the steakhouse, 25 bucks is it.
Okay.
Yeah.
All right. Next question for Karen, the dreaded question. What are the chances of me getting audited?
I don't know. My answer to that is file correctly and who cares? It really doesn't, that's not a concern to me, because if the tax return is done properly, then there's really not a concern. So good record keeping, what's the likelihood of getting audited? I honestly, I didn't check the statistics that are out there. The poor IRS is so overwhelmed right now. I don't know if anybody's getting audited. Most people are going to receive something called an AUR letter. If you do get audited, it's a form letter that comes out that says, hey, we think there's usually a discrepancy where maybe your total income doesn't match the 1099 that was issued from your broker or something along those lines. But again, just everything that we're talking about here, getting audited is not the kiss of death if your records can support what you're claiming. Getting audited is very stressful when there's maybe not one gray area or shady area or best guesstimate. It's when there's multiples of those, then the audit becomes a problem.
Okay, great. Thank you.
Heather, we had some statistics here.
Oh.
Karen and Bob, I just had to look it up. I just thought, what the heck? In 2017, there were 196 million returns that were filed. Okay, IRS statistics. Field audits were 0.0013, where they actually came to the location. That's 254,800 out of 196 million. Letter audits were a little bit higher. They were 0.0038, or 744,800 out of 196 million. And then this one, they said basically the audit rate on all returns is roughly 0.5%, which is 980,000 returns. So basically 99.5% of all returns filed are not going to be audited.
And the ones
based upon these statistics that I'm sharing.
The ones that are audited, is it usually that the IRS has some sort of red flags with it, or are they just randomly picking some people?
Yes, it's most of the time, and what they're talking, the AUR, automated underreporter letters, there's something there that doesn't match. A W-2 doesn't match, a 1099 doesn't match. There's something that's been reported to the IRS that doesn't tie to your return. Now, it could be, if you're getting alimony from your husband or for previous spouse, your numbers and their numbers have to match. If they don't, you're going to get a letter. I'm surprised the numbers are that low, but actually 0.5% is about right. Now, I will say that the IRS is trying to beef up their personnel some. They've had a 20% budget cut in the last decade, and it's cramped their people a lot. But they're trying to staff back up on the people, and they're going, or say they're going, to focus on small businesses because they think that's a problem. That's a problem here. And it probably is. Joe Sixpack with 2 W-2s and a mortgage statement is not really going to be an audit target as long as this stuff is reported correctly. But gee, guys, with mileage and cell phones and home offices, and guess what? You could be a problem. So keep your nose clean. I'm like Karen. If you do the return right to start with, this shouldn't be a problem.
Okay. And someone, oh, go ahead.
I was just going to add to what Bob was saying. You're exactly right. The top 3.2% of returns for people on a 1040 where the income is greater than $1 million. So 3.2% of all audits have, go for the highest income people.
Okay.
And that's usually where the most tax exposure is. So you would think that's why they do that.
We have a couple things that came in. Are there any specific auditing timeframes?
Okay. You'll start to get a letter from the IRS about 18 months after the returns are filed. That gives them time to sort through and match everything and go from there. That's when we start to see the AUR letters. The IRS has 3 years from the time the taxes are assessed to audit your return. If they don't make it in 3 years, then they're done. Unless there's a substantial understatement of taxes in the return. Substantial understatement is the greater of 10% of the taxes due, or $5,000. So if you got a pretty hefty thing, they've got 6 years. If there's fraud involved, the statute never runs. You're always open. But basically, for most folks, 3 years is the limit. If you get past 3 years from the tax filing, you're pretty safe.
Okay. And then one other IRS question. In the IRS's eyes, do clients have to have had a transaction this year, or are they considered anyone who's ever had a relationship with client or prospect and are continuing to touch?
I don't understand the question.
I don't either.
I think what she's trying to say is if I'm sending gifts to last year's clients because I want to keep my name fresh with them and hope to get referrals and stuff like that, is that considered a client gift? It's again, there's gray areas everywhere. Yes, that's probably a client. If they're a 1-year-old, not a current client, you can't be giving $100 gifts, to them and write that off and kind of. So I would probably apply the same theory to that.
Great. All right, thank you guys. Next question. This one goes to Doug. Can I write off meals and alcohol?
Saw some people going like that. Business meals, you can write off 50%. Now, if there's alcohol involved, I would keep it to a minimum. I mean, if you're trying to prove to an IRS agent that you spent $35 on a dinner and there's $75 in alcohol, I doubt they're going to let you write off the full $75 because that wasn't a business venture. It was a booze adventure, really, if you think of it that way. So I would be practical about it. Keep it to a drink. That's going to be fine. But again, under current rules, you have to keep records of that, substantiating why you took that person to dinner, potential client, what you discussed, And of course, you have to have the receipt for it. So.
Great, thanks.
Let me, I got to jump in here. The rule for something being deductible is that it's ordinary and necessary for the production of income. If you go out and have that $100 deal and 75 bucks of it is booze, but you come back with a signed contract, you got a leg to stand on there. I had to get them drunk, Your Honor. But ordinary and necessary. Okay, I have 2 dogs in my office. They're great publicity. Folks like to come see them. They ask for the dogs if they don't see them right off the bat, but they're not necessary here. I don't get to write off anything. I have a client who's a doctor. She has a therapy dog in her office. That dog gets treated better than any 3 of mine ever did. And she writes off everything because it's ordinary and necessary in production of income for her. Same thing would be for somebody who's running dogs in a junkyard. It's necessary for security. So the situation changes, and truly the answer to virtually every tax question starts with it depends. It depends what's reasonable. $35 in Snell is different from $35 in Arlington. Where are you and what's involved?
Okay. All right, thank you. Next question for Bob. Can I take a home office deduction?
Yes, but it depends.
It depends.
Having a home office is not a red flag. It's not an automatic invitation to be audited. If it's a place where you ordinarily conduct business and it's used regularly and exclusively for the conduct of business, then you've probably got a pretty good leg to stand up on for writing it off. If your employer provides you with an office, you're getting toward the no, you can't. Right now, there's a whole lot of questions about folks who are working from home because of the pandemic. And frankly, some of that hasn't been answered. We really don't know where the rulings are going to come down on it. But I suspect that these folks are working at home, and the portion of their house maybe that they used might be deductible, depending on exactly whether or not they're an employee. Employee expenses are different from independent contractor expenses or self-employed expenses. So there's some wiggle room in there, but generally the answer to it is, yeah, you can probably write it off, particularly for y'all, which you're self-employed, you're independent contractors. Yeah, you've got a leg to stand up on.
Okay, great. That's good to know. Okay, next question for Karen. My kids have been working for me. Can I write that off?
Yeah, you actually can. Especially if the children are under 18, there is a way. If you're going to use that, generally the standard deduction for currently for 2020 was $12,400. So technically you could pay them up to that amount and it would not create a tax liability for them. You're actually not required to pay FICA taxes as you would on some other employee that you hired if you were going to pay them through payroll. One thing that I do like to caution everyone about is we're all looking to save money, but what we find sometimes is people are so busy writing everything off or trying to find ways not to pay any federal taxes. And, I find the rules, use the rules and things like that. Just consider not just the short-term effect of decreasing your tax liability, but also the long-term of what that's doing to you. When you're paying self-employment taxes, you're actually building your future Social Security benefit as well. So, we've seen clients pull their statements and, they're claiming $12,000 in income when everything is said and done at the end of the year because they've used everything besides the kitchen sink to write off. And that just means that you're not going to be eligible for much or any. Some people that's not a concern. So I do like to put it out there. I don't mean to take away from the question, but the question is, yes, you can actually pay your children. Now, if your daughter is 8 and you're saying that you pay her $1,000 a month because she handles all of your phone calls and your filing and things like that, well, I'm not really sure if that's, probably adequate there. So, check your child labor laws and things like that to be able to, to make sure that you can do that. But yes, that is good. If the child is 18 or over, and you're paying them as an employee, then you are required to pay Social Security and Medicare taxes and issue W-2s, which you are with the other as well. But the rules do change once the child gets a little bit older.
Okay, great. Thank you.
All right, Heather, let me throw one in there too. Talking about a young child. I had a client a long time ago who had a new grandchild, baby in arms grandchild. And they used that baby in their advertising campaign. No, baby showed up on a regular basis. They paid the child $3,000 for the modeling fee, which just happened to be the amount that they could put at that point into a traditional IRA. So they put the $3,000 into the IRA for the child, and the child had a heck of a leg up on a lifetime saving. They got to write off the $3,000 and the child got some benefit out of it. So there are reasons to do things like that sometimes.
That's a good idea. Okay, great. Thank you. Next question for Doug. How often can I take a loss?
Interesting. IRS actually is set up to collect income tax, not to not have you pay income tax. You have to be careful in this scenario. If you have a client that comes to you year after year and they're showing a loss and they're not an LLC and they're a sole proprietor, it might be a hobby. And under current rules, you have to count all that income. And because of what they did in the Schedule A with the Tax Cut and Jobs Act, you can't even write off hobby expenses anymore. So you have to be careful about that. And so I very much caution clients who are losing money annually, and I ask them, what's your marketing plan? What are you doing in this business? Well, yeah, I probably only work maybe 20 or 30 hours a month. I said, well, that's not really a business. That's just when you get to it. So it could potentially, and I'm sure Bob and Karen both can speak to situations maybe where they've been before the IRS, where a client just has these huge losses and they don't have a leg to stand on. And I don't want those kind of clients, I'll be honest with you, because they're not trying to do it the right way, and I'm about doing it the right way. So there's some history. You got to look at the history of what they're doing. You got to look at the industry that they're in and substantiate the expenses. What kind of plans do they have? But you can't just arbitrarily write off. I know the old rules used to say in a 5-year window for a hobby, you had the IRS was okay with you losing 2 of those 5 years, figuring you have startup expenses. It's going to take a while to get your business ingrained. When you get to year 3, if your income is going down and your expenses are going up, that's a problem. That's a red flag to the IRS. So I'd be careful about that.
Okay, thank you.
You want to jump in there, Karen?
Yeah, I mean, I think it's, pretty much every answer that I've heard, it depends. And well, in some situations, I really think that the bottom line with most of what we're talking about is you really want to work with someone, because there are different circumstances. We've seen clients that have had losses for more than those 3 years, but we can see the plan. We can see that they're reinvesting, they're growing, they're building. And so I don't put that same rule. Doug shaking his head. We know exactly what we're talking about. So, as a realtor, the difficulty is you're generally operating by yourself. I know that there are some teams. So, we do have to start to question as a realtor, sometimes I kind of giggle and say, maybe you're not in the right line of business if you're losing that much money. But by the time you pay all of the fees and things that you're working with, it's more difficult as a realtor to show consistent losses year over year and be able to support that.
The 3 out of 5 rule for profit is still there, unless you're in a horse-related industry where it's 5 out of 7. But if you do have a business plan, and I'm not speaking specifically of realtors, maybe I should because that's the audience, but if you do have a business plan and you can show where assets are appreciating and you have a way to get to a profit and you're working that and you've hired professionals to advise you and you're seriously working this business at making your profit, then you've got a leg to stand on regardless of the 3 to 5. But the profits have to be in relation to the losses. You can't lose $50,000 on 2 years and make $100 the other 3. That doesn't work that way. They have to be, has to be some relationship there.
Thank you. Okay, next question, switching gears a little bit. This one looks like it's directed to Bob. I literally did not own a laptop, printer, or iPad and purchased those items simply because I decided to become an agent. Can I write off these purchases?
Yes.
Great.
It's a short and simple answer. Yes, you can. And you can, assuming you're using them 100% for business, because you never used them before, but if you used them 100% for business, yeah, you can write the whole thing off and go from there. There's no requirement that you own a laptop before you go, or that you have any equipment. But if you buy it specifically for business, sure, it's deductible.
Okay, great.
Ordinary and necessary.
Right. Okay, good to know. And then Karen, this kind of piggybacks on that, what we were talking about before. Can we write off any of the extra equipment we've purchased to work from home?
I'm going to say yes to that. And I always follow that with ordinary and necessary. Again, it's the pandemic this year has kind of changed the way that we're all doing business. So as a business owner, sometimes you have to regroup and reorganize yourself. What was working is no longer working right now. So just keep track, with the equipment of the business use of that. So if you, buy the family a new, laptop or something like that, and it's used for multiple purposes, then we can't really write off 100% of that, but there might be a fair amount of business usage to that. So you just have to, monitor the use on the equipment that you're purchasing.
Okay, great. Thanks.
I'm just going to make a point. Sometimes time can elapse when you buy an item and when you actually put it in your business. So then to play it safe, like for example, we know that computers and laptops and printers depreciate very quickly. So say somebody bought one a year ago and now they're using it in their business and they spent $1,000 for it a year ago, I wouldn't write off $1,000 now, because it's whatever it was used in the last year, it's not valued at that same amount. So I would come up with a reasonable fair market value. I mean, the IRS says that technology equipment lasts 5 years. My IT guy says 24 to 30 months. So if you even if you go to a 3-year rule, then you spend $1,000 on this equipment, you might want to write it off at 2/3 of that value, because for the last year you weren't using it in your business. So just as a precaution, that's what I normally do.
Okay, great. Next question for Doug. What happens if I don't pay my taxes quarterly?
Ouch. It's hard to put that money aside, but I think it's necessary. Now, there is something called an underestimated penalty. It used to be 80% several years ago, and now they've upped it to 90%. So if somebody, again, keeping the maths simple, owes $10,000 in taxes, but you've paid in 90% of that and you owe $1,000, you're not going to get penalized for that. But in your business, where you are not having taxes come out of your commission checks, then the onus gets put on you to make sure you put some aside. And I like the example early on where it was 75% and 25%, and you had a money market account. So you're actually sliding the funds into that. And then once a quarter, you're sending in that voucher and that check, or you can even do it online, set up an online account, IRS direct pay, or get a Virginia account, and do that on a as-you-go basis, because my argument or my comment to my clients when I see them in February, next month, and then March, when I'm doing their tax return, I will say to them, hey, look, you owed $6,000 last year, and here's the penalty. Let's set up a plan April 15th, let's send in something. June 15th, let's send in a second installment. September 15th, and then January 15th of the following year. So if you do that sporadically, then you're not having to write that huge check when your tax return is being done. And there's no penalty added. So there are two good reasons to do it.
Karen or Bob, do you guys have anything to add to that?
I'll weigh in on that one. I think as a realtor too, it's your world. I think where I've seen the most frustration from realtors is saying, you know, my accountant last year put me on this plan and they said I'm going to pay $3,000 every quarter this year. Well, that probably works great in the summertime when you're busy, but January, February, March, that's usually just a scary figure that I haven't done much of anything. This year might be a little bit different with that. So the way that I work with my clients is we work on a monthly basis. I say, just like you're gonna, pay your mortgage or pay your cell phone bill or things like that. If we work on a monthly basis, then you're keeping track and saying, oh, I had $10,000 in commissions this month, and the previous month I had zero. Well, we figure out what the payment should be based on 10,000, not just a fixed amount every single quarter. I don't think that works really well unless you're very disciplined, and if you have the excess cash and you're rule follower and very regimented. I'm not saying don't do it that way, because that works, but for a lot of people that are more on a cash flow as it's coming in, I think sometimes that can work a little bit better for you.
I agree with Karen. It's kind of the way that I recommend folks to do it. There's a specific time you have to make your first payment, April 15th. Then June 15th, September 15th, and January 15th. Well, on April 15th, you're looking at your profit through the first quarter. So, God, I know it's the end of March, just before taxes, but we try to look at folks and say, all right, how much have you made this quarter? What's your tax bill for that? Then we get to June. How much have you made so far? What would the tax bill on that be? And subtract what the first payment was, and figure out where you go, so that on a rolling basis, you get to the end of the year and you hope you've covered just about all of it. And you've done it in the appropriate increments to avoid the penalties for underpayment.
Okay. We just had a couple of questions come in on this. First one is, my quarterly payments never match when the earnings occur. How can we avoid penalties for those excess quarters?
I think I just answered that when you figure it out as you go along and look at where your profits are each quarter.
Okay. Next one is, I became a realtor in 2020 and didn't realize I needed to pay taxes quarterly. Do I owe penalties?
Possibly. The first year, or any year, estimated tax penalty has a safe harbor based on the prior year's taxes. So if you didn't have any tax bill in year one of 2019, and then 2020 you picked up an unpaid tax bill because you didn't know you should make quarterly payments, there's going to be a safe harbor there based on the 19 taxes. The year going forward, 2021, they're going to look back at 2020. So yeah, but you probably be okay for 20. And that said, the penalty for underpayment of estimated taxes is not terrible. I had a client some years ago, to put it in perspective, she got to the end of the year, owed $44,000, and she had a $1,400 penalty on it. Well, she said, well, hell, I got more use for the money than the government does. I don't care. But $1,400 on $44,000 kind of gives you a feel for where it might be.
Okay, great. Thank you. Let's see. Oh, wait, let me see if there's any more. Hold on one second. Okay, we've got that. Okay, next question is for Doug. Nope, I got Doug. Next one is for Bob. What tax laws have changed in 2020?
What didn't? I mean, you think, well, gee, we had a big tax law change in 2017, but everywhere we look for 2020, stuff changed. The PPP loans, the $1,200, $600 credits, all sorts of stuff changed last year. And it's really just sneaking out, at least for me, it's sneaking out and going, dang, I didn't think about that. I didn't think about that. Lots of stuff changed. I can't just say, this did or that didn't. It's just a lot. I mean, Karen and Doug, you may want to put your finger on something specific, but everywhere I look, things changed.
I think you're right on, Bob. The ones that I happen to notice, just as a happenstance, if you don't itemize, you can write off $300 of donations that you make. That was something that they threw in there. And then the other thing, typically for years and years, you could actually donate up to 50% of your adjusted gross income. When the Tax Cut and Jobs Act was passed in December of 2017, that 50% increased to 60%. Well, for 2020, it's all the way at 100% now. So I don't know if there are many people out there. Of course, there are wealthy people that probably can give away, all their income. But those were the couple that I just came across. But you're right, Bob, and every time you turned around, there was something new coming down the pike. But those two just happened to hit me, and I just remembered them.
Someone asked if meals have changed. Are they 100% this year?
I think that just changed. Don't hold me to that. I think there was just a change to that in the last week or so. But I seems to me that I remember seeing we went from 50 to 100 as a help to, yeah, it did. It went from 50 to 100 to try to help the restaurants by allowing more people to write off more.
Okay, that makes sense. Okay, great. We also had a question. What is the range in fees that people can expect to pay for services? Like, what's typical payment they can expect for you guys?
Remember those two dogs I mentioned? How big are they? You don't know until you look at it. Seriously, people call all the time. How much does it cost to have a tax return? I have no idea till I look at it. My tax returns run $50, $75 for somebody that's really low income and really simple, to several $1,000s, depending on what's involved in it. And you just don't know till I look at it.
Yeah, I totally agree. When people call me and they're just price shopping, and I understand that. I price shop, but I will say to them, you want me to give you a quote on something I haven't seen. I don't know what's in it. And earlier in my career, I always wanted to please everybody. And I was sticking my foot in my mouth, and people would show up and they had a business, and they didn't tell me they had a business. Well, the business return is a lot more involved. It'll cost more than an individual. And I had people getting upset and mad at me. And I said, you know what? I'm not doing this anymore.
I don't mean to interrupt. So I guess a better question then, because that was actually my question, would be, do you charge a consultation fee so that you could then be able to better inform us as to what it would cost us to use your services? Do you charge a consultation fee?
In our office, if you want me to give you a price on your return, bring it in. I'll take a look at it, and I won't charge you for that.
Me too. I do the same thing.
We're the same. We're free consultation, and I think it's important to. I tell people all the time. I do understand price shopping, but you really want to create a relationship with someone, because you're going to have questions in March, you're going to have questions in August, and you're not to. It's very important personality wise, I think, is to find someone that you work with. If I'm too strict and your brain doesn't work that way, it's probably not a good fit for either one of us, because it's, will harass you and drive you crazy and create anxiety and stuff. And we don't want to do that. We just want to keep your stuff organized for you. So I always recommend to people, it's have an interview with a couple of people, because it's just, just like your clients. There's some clients you love working with, and then there's other clients, if you see their caller ID come across your phone, you're dying going, oh my gosh, here we go again. So you want to kind of get that first situation settled for yourself. So yeah, definitely.
Great. Thank you guys. Does anyone have any other questions? That was my list.
I'll do one last thing from me is, as a realtor, I beg you, please don't call and want to set up that consultation on April 5th, because we're tired and grumpy at that point. I think that's going to be our deadline. But in all fairness, I have some realtors that have already gotten started. we can see where you're at right now too. We can give you a good idea as to say, you know, you are going to owe $20,000 on April 15th, but at this point we have 2.5 months to figure out where that $20,000 is coming from, versus on April 10th, that's just kind of a scary, where am I going to move that around? I don't have that. And you know, what's the strategy to pay, what penalties and interest I'm going to have. So that's my plea.
I've got to go along with that. If you come to us on April 1st or 4th or 5th, and you're a new client and you've got this much of a stack of records, here's your extension. You know, we'll take a look at last year's return and say, well, is this like last year? Why don't you make an estimated payment of whatever and give us time to work our way through it. But you know, in April, if you come in, unless you've got basically a W-2 return, you're not going to get it done, because we simply don't have the time. And I'm not one of those, our office is not one of those offices that we're going to work till midnight or later every day for 3 weeks to do it. Ain't going to happen, folks. You've had 3 months. Yeah, we need to live too.
I couldn't agree more. Current information that you know of, don't delay. You know, sometimes knowing is a whole lot better than not knowing. So even if the news is going to be bad, I'd much rather know about it on February 10th than April 10th.
Yeah.
So.
Guys, and I just wanted to let everyone know, in case you have any questions, you're looking for contact info, there's going to be a follow-up email to this, and it's going to have Karen and Bob and Doug's information in there, so you can reach out to them.
Okay, I saw a question pop up just now. If you make another estimated payment now, can it go towards last year? Absolutely. Anytime you send a check to the IRS or do it electronically, you can specify where you want that to go. Right now, you say 2020 1040 with your Social Security number, and that's where the IRS has to put it. You can owe them $1 million otherwise, but if you specify that, that's where it has to go. If you don't specify it and you owe them back taxes, they can apply it to the best interest of the government, which starts with interest, then to penalties, and finally you get to the tax. So always put your social and where you want it to go in the payment record, whether it's electronic or personal or paper.
Great advice.
Great. Anyone have anything else?
Oh, come on. You can't have run out of questions.
There's one question. Are all of you taking on new clients at the moment?
How big is the dog? Yes. Yeah, we've got room for a few.
Yes.
And I'm sure Karen does.
We do pull a lot of the late nights over here though, so we'll go that route. It is what it is. I'm a procrastinator, so I get it. I understand people that work that way. So it's I do have a sympathy card that I pull for that one, but I'm way nicer in February than in April.
Yeah, my
You
mission.
hear that? Get your stuff started now, everybody.
Yeah, is to try and help folks. So sometimes to a fault, I may take on more than I should, but
yeah,
it works out in the end. It just does.
Yeah, we realize that there are all kinds of people out there, and we work with most of them, if not all of them. I have one guy that January 1st, invariably, he's going to send me his S-Corp QuickBooks file, reconciled and ready to go. You know, come on, dude. I mean, I hadn't even got over last night's hangover, and here you are wanting your tax return. Yeah, not everybody's going to be like that, and we understand that. But by the same token, you know, you've had 3.5 months by the time you get to April 15th. If you've been keeping your stuff together, like we said, you use QuickBooks or you use Excel or whatever, or you've got your stuff in envelopes or a 12-folder file. If you've got your stuff organized, when you get your mortgage statement and your 1099s and whatever else you get, bring it on in. Even if it's only 80% of what needs to go into your return, bring it in and let us get that much done. And then when you get the rest of it, we can finish it. But, you know, help us smooth out the tax flow some. It makes our life a whole lot easier and makes us a lot less grumpy. Right, Karen?
Anybody have anything else before we wrap up?
I just want to give a shout out to Heather, who's done amazing on this. That's all. Thanks to him.
Okay.
I totally agree.
Right. Guys, thanks. Well, thank you guys so much. If there's nothing else, we're going to go ahead and wrap up. And again, you'll get an email with everybody's contact information so you can set up appointments. Thank you guys. Thanks, Doug, Karen, and Bob. We really appreciate it.
I appreciate the opportunity to talk to all of you. It's kind of fun. Yeah. You never know really where things are coming from.
Yeah, this was great. Definitely. Thank you, guys.